What makes you so confident you can meet your targets, and are you concerned about oil prices? We've seen them drop by almost a fifth in the last 5 weeks.
Well, good morning, Matt. Well, yes, indeed, we live in a very volatile market. Our industry is used to volatility in the price of the commodity that we are exposed to. If you look at confidence, yes, we are confident. First of all, we believe, as you said yourself, that the outlook for 2020 is pretty much de-risked. So that's $28 to $33 billion of organic free cash flow. For 25, we see that grow to $35 billion. That's at an oil price assumption of $60 Brent real term, which I think is a reasonable and a conservative oil price assumption. So our strategy has been working well. We expect it to be working well going forward. But at the same time, Matt, we're also repositioning the company for the future of energy. So yes, continuing to invest in upstream, which is core to us, but also making sure that we are very well positioned for the energy transition with our market-facing businesses doing well and actually investing more in them than in upstream.
Ben, very good morning to you. It's Anna here. I wanted to ask you about that investment in the future. You've said that you're going to be focused on core upstream. I wonder, could you tell me, what does that mean? Does that mean no deep water, no Arctic, no heavy crude? What's the definition there that we need to be mindful of?
Well, we talk about upstream as actually our core themes. It's core to Shell, it's core to the success of Shell. And in recent months and years, I think there has been some debate on, are we well positioned in upstream? And I think we are. We have, over the last few years, of course, significantly rejuvenated our portfolio. So yes, indeed, we have gone out of heavy oil. We have not proceeded with our Arctic ventures of a few years ago. We now have 3 very strong themes in upstream, which is the more conventional oil and gas business, which is a business with very long running rooms, very high quality portfolio. We have deep water, which we have completely revitalized and reinvented into a much more capital efficient business. And then we have our shales position, which is also very much a business in the sweet spot. And these 3 businesses, shales, conventional oil and gas, and deep water, they will be core to Shell's upstream portfolio going forward.
What we're trying to figure out, Ben, or what we're trying to get from you is, can you quantify how much you're going to be spending on new energies? And is Shell going to avoid some of the high carbon activities like ultra deep water drilling?
Well, Matt, as I said, we want to position the company for the future of energy. The future of energy will involve oil and gas, by the way, but it will also be a future where much more of the dynamics in the market are dictated by the customer. So our customer-facing businesses like integrated gas, oil products, but also petrochemicals will be core priorities. We will be investing about $13 to $15 billion of cash capital every year. Compare that with 11 to 13 in upstream. Now, at the same time, we want to grow a new power business alongside that. We want to do that simply because we see there is tremendous potential in that business, not because of what we liked in the past, but more how we see it in the future. So far, we have invested about $1.5 billion in it. We are going to step up the investment levels gradually in the 21 to 25 period. So think of $2 to $3 billion of cash capex a year. But we will do that prudently, with conviction, but prudently. We want to make sure that that business grows up to be a 4th main business for Shell. But of course, we don't want to get ahead of ourselves. Will that mean that we will avoid high carbon businesses? Well, yes, the carbon intensity of our product portfolio will need to come down. It will need to come down as society decarbonizes energy as well. So we want to be in line with society on the way to Paris. So we are halving the net carbon footprint of our product portfolio, and power will indeed play a role in that.
Okay, so on the way to Paris, we find your power ambitions then, Ben. A little bit more on that and how you said you'll just go cautiously into it, which I heard. But how do you address concerns around margins in that part of the business versus the more traditional areas for Shell?
It's a very good question, Anna. And I think, if you look at the fundamentals of what the energy transition is all about, it's all about, again, decarbonization, which basically means that the world will have to consume its energy much more in the form of low carbon electricity than it has in the past. So we see a tremendous growth opportunity in electricity, but we also see at the same time, of course, more interruptibility on the supply side, much more dynamism on the demand side, and therefore much more disruption. And we think, therefore, that the power business of the past is going to be disrupted and replaced with something that is much closer to a business where it can play to our strengths. And that's why we want to be experimenting, let me put it that way, into that business on a relatively large scale, and we believe we can make returns in the range of 8 to 12% from that business. Now, that is a business of the future, a business that doesn't really exist at this point in time. So that's why we want to move cautiously, and we will only ramp up this business as we see these proof points of an 8 to 12% return come through.
It's great to be getting this forthrightness and these numbers from you, Ben, and you've gone further, I think, than a lot of competitors in laying out what you're going to do in terms of transitioning to new energy. I wonder if you can give us some numbers in terms of your inorganic growth. You said your spending is going to exclude the $32 billion, excludes inorganic growth. And you've also said in the past that you're a bit small in the Permian region. I know you're not going to tell us exact acquisitions that you're looking after right now, but can you give us a ballpark figure of how much you want to spend on those things?
Well, Matt, you're absolutely right. The numbers that we mentioned today are organic numbers. So we need to sustain our business. And if you look at sustaining our business, we roughly need $20 billion of cash capital a year. We expect to spend about $30 billion of cash capital in the period 21 to 25. So we are significantly growing the value of our business, as we have been doing for the last few years. So a very important first point to notice, we do not need inorganic spend to get to the promises that we made. The $125 billion of potential shareholder distributions, we can deliver that on the back of an organic investment program. Now, having said that, of course, we will take a look at inorganic opportunities throughout the portfolio. Indeed, I've been on record in the past by saying I really like our Shell's position. If there was one thing wrong with it, it is maybe a little bit too small. And therefore, we will look at opportunities as they come along. But we will only pursue these opportunities if they really make sense. We're not going to be seduced by sentiment in the market. They really need to make sense, and they need to fit within our financial framework, of course.
So those need to make sense. Ben, I'm in Downing Street today covering the visit of President Trump, of course, to the UK. There's a lot at stake for UK-US business. I understand that you had a seat at the banqueting table last night. Give us a sense of, just briefly, the mood in the room and why this matters for your business.
Well, I think the mood in the room was very gracious. I thought the comments made by Her Majesty, but also by the President, were very affirmative of the special relationship that the two countries have. Of course, in the margins, there was also some talk about trade and the future of trade relations, etc. But I think both heads of state were very much focused on reaffirming the special relationship that the two countries have. For that matter, we also have a very special relationship with the United States. We invest about 40% of our capital in that country, $10 billion a year. And therefore, we pay great attention to the future of that economy, how regulations come about. Yes, we are, of course, also worried how trade sanctions could complicate, particularly the supply chains that we have in building up projects in the United States. But then at the same time, these are things that are ultimately, in the bigger scheme of things for our business, temporal. So we have to have a strategy that is resilient to oil price volatility where we started, but also to geopolitical events and even volatility in the general economy. That's why we have a very conservative approach to our balance sheet. That's why we have very conservative assumptions for the outlook. And that's why we are very confident that our strategy, which is very much focused on moving towards the customer end of the energy system, is going to be a winning strategy for the future.